This is a DeFi panel, so with a quick raise of hands, I want to know how many of you just have used dApps in general? Raise of hands. Nice. Higher. Nice. I love it. Let me just pull up my next question. Yeah, and now that everyone's raised their hands, it's the question is for them. How many of you are excited about the next sort of phase that we're going in, where you can buy stocks on chain or trade derivatives, like real world assets on chain? How many of you have actually done it? Pretty damn cool. So please answer my questions in the panel. Yeah. So the first, okay, before we get started, I think we should do like a quick round of introductions because everyone here has been working super hard, and when I look through their Twitter profiles, websites, stacked work, so they deserve some recognition at least.
Hi, I'm Yash, currently the co-founder of Copilot.markets, emphasis on the Copilot, there's no S. Uh, Previously, Copilot.markets is a agentic prediction markets companion where you can trade on Polymarket via an agentic interface. Previously, I was an engineer at Paradigm working on Foundry and Alloy, which are the most used developer tools. So every other Solidity smart contract that has been deployed on any EVM chain has probably touched my code indirectly. Yeah.
Beast. All right. Hey everyone, I'm Tanay. I work as a researcher at Propeller Heads. We build infrastructure so that your swaps execute fairly on chain. And if you do our job right, eventually you'll be able to buy oil on chain for a cheaper cost than you would on NASDAQ.
Love that. Hi, everybody. I am Archana, and I lead growth at SSV Network. SSV is a protocol that distributes Ethereum validation, and instead of having all validators run everything on one cluster, you are split across different nodes so that Ethereum validation can remain more decentralized. I have been doing DeFi for about 5 years now.
Damn, that's pretty stacked. So I think for some context build up, there are two movements that are happening in parallel when it comes to DeFi. The first is stocks coming on chain, where you can trade like you can buy spot oil, which you couldn't have like 2 years ago. And the second movement that's happening is speculation platforms like Avantis, Hyperliquid, where you can actually trade real world assets um, closer to like the CFD trading that we do in TradFi. So that brings up my first question, targeted towards Yash. So as you've built like so many products that devs use, uh, in simple terms, right? When you talk about things going on chain or like on chain fintech, what does that actually mean? Like if you were to draw parallels between what Zerodha and a perp dex or like a dex say Aave has in common.
Yeah, so a couple of things there. First one is just self-custody, not your keys, not your money, basically. So on-chain fintech, you control your assets on your hardware wallet or any other phone or any other wallet you have. Second is the access to new trading opportunities such as crude oil, copper, or let's say even for emerging markets where hyperinflation is running high, those people can access basically USDC, and that serves as an inflation hedge for them. Third is just 24/7 access to markets. So all in all, these are the three core value propositions I would say that on-chain fintech has that TradFi doesn't have. And to draw parallels on the Zerodha versus a decentralized exchange, so Zerodha is actually a broker, and naively you can put it as an interface to the exchange, which is like the Bombay Stock Exchange or the National Stock Exchange. But a DEX on chain is the DEX in its entirety. So all the trading logic, it's completely on chain and in most cases verifiable and open source.
Yeah, and I think all these TradFi giants are now sort of insecure, anxious, and also moving to like 24 by 5 stocks, like trading hours. So that's pretty cool. My next question is for Tanay. Solvers compete to get like the best price, right? If I want to trade oil, and you said that soon you could get the best price on chain than any other exchange. I'm a retail buyer. I'm probably using Zerodha. Why should I, like, what are the pros? Why should I try to buy it on chain?
Yeah, I think that's a very interesting question. The best way to understand is by kind of drawing parallels between how your trade gets executed. Let's say when you're buying GameStop stock on Robinhood versus buying Ethereum or buying oil on an auction like CowSwap that is run by solvers. Just to get a feel for the room, how many people here have watched the movie Dumb Money? That movie about how the GameStop mania happened on Robinhood. Okay, exciting. So Robinhood is a traditional exchange. A lot of people use it in the United States to buy stocks in a centralized fashion. When you're executing a trade over there, what happens is your order goes to one of 6 market makers. This paradigm is called payment for order flow. So one of these 6 market makers will quote you a price and they will execute your trade on on the traditional finance rails. This is the entire mechanism. So there were 6 entities involved, and this is how 91% of US retail trades are executed today. Now let's come to the on-chain paradigm. So a user goes on an app called let's say a CowSwap. A CowSwap is essentially a solver auction. You enter your trade intent. I want to buy 100,000 USDC or 10,000 USDC worth of Ethereum. Your order enters the order book. There are at any point in time anywhere from 10 to 15 solvers. Solvers are entities that have specialized routing knowledge or market making knowledge who can compete to give you the best price for the trade. Now, having these 15 entities is actually quite crucial. Each can specialize in different parts of the trade. Certain solvers might be really good at swapping from stables to stables. Certain solvers might be very good at doing this thing called batching, which does not happen in traditional exchanges at all. So what batching essentially is, let's say I am selling, my USDC for ETH. Yash is selling, Yash is buying ETH for USDC. We could be matched against each other, and this is theoretically the least costly way to execute your trade. Like if I match against an opposing trader. There are solvers on CowSwap who specialize in making these batches and doing these coincidences of wants. And that kind of further reduces cost for the user. So you have 12 solvers. They will route your trade through, let's say, some Uniswap DEX pools, some PancakeSwap DEX pools, some market makers. And let's say you go do this entire process of discovering how your trade happens. You kind of then come up with a route, okay, send 40% of the trade to Uniswap, 30% to this market maker, and the remaining to PancakeSwap. You've done this trade. This bundle, this trade, then goes to, let's say, another auction where there are searchers competing to backrun this trade. This is called a bundle, and backrunning is essentially an exercise where searchers will compete to execute this trade. So the proceeds from this auction will go to the user again. And so there, let's say anywhere from like 10 to 30 searchers compete in these auctions. And then finally, the bundle goes to block builders and eventually validators run by teams like SSV. In this entire supply chain of this trade execution, there were anywhere from 25 to 35 parties involved, all competing to execute the trade for the user to minimize cost for the user, as opposed to 6 in TradFi. Now, this trade supply chain for the on-chain execution is not perfect, and there is a long way to go and many improvements to be shipped. I suppose we'll get into that in a moment, but this is what's happening on-chain. So now it's for you to decide whether you want people competing to give you better trade execution, or you want people competing to extract most value from you, and that's pretty much the contrast.
Yeah, I think that's a pretty solid explanation. If I were to double click on it, right, how does it work? How easy is it to become a solver in, like, say, TradFi? Because there are only 6, right? For me, it's easier to make that process decentralized than for a user to onboard to crypto and go through all the hassle.
Yeah, that's an excellent question. In TradFi, as I said, most of the trades get routed through 6 market makers. The licensing costs, the compliance costs, the liquidity inventory required to, begin participating as a market maker, that raises the barrier to entry to like the order of like millions of dollars. Whereas if you want to become a solver on CowSwap, you could get started in less than a month. And now we ourselves are building open source infrastructure that reduces that time even more. I know of plenty 1 or 2% solver teams that are competing and making decent revenue today, whereas Citadel is what, 610,000 employees.
Yeah, so essentially, people are working overtime to give you the best prices, and they only win when your trade goes through. They
Exactly.
only earn money when that happens.
Exactly.
That's pretty cool, and I'm like, personally very passionate about this space and curious how it evolves in the upcoming years. My next question is for Archana. When people talk about finance going on chain, say, like same example of crude oil, what what do they actually mean? Do they mean that the asset underlying is going on chain, and how does that even make sense?
Yeah, no, that's a fantastic question. I don't want to be a contrarian or undermine how this translates to people, but that's not an invalid perspective, because every time someone's told about being onboarded onto Web3, you are always given a very investment first sort of an approach to it, saying come, make some money, hold some assets, etc. However, assets being on-chain hardly, in my perspective, is about taking something and putting it literally on the blockchain. RWAs is a very real example for how something that's off-chain can categorically translate into on-chain. Stablecoins is something that everyone's talking about because it's a very sought after on-chain commodity. However, for me, assets and their utility is kind of where the problem ends and the onboarding begins. But for this to happen, I think you need very solid infrastructure. Today, networks like Ethereum, which I also predominantly work on, are already doing billions of dollars of transaction, which potentially may not have been possible if the infrastructure underlying it could not support it, right? Financial markets, as we know it in the traditional sense of finance, is also what it is because of the financial plumbing around it. You have custodians, you have KYC processes, you have escrows, and it's very similar for how that translates into on-chain financial markets, or what we call DeFi today. Without this plumbing, or without what we call crypto payment rails, what really are you doing talking only about assets? Right now, SSV has a TVL, which is assets under management for any DeFi protocol or any TradFi protocol, of 6.7 million ETH. 6.7 million Ether is right now staked on SSV, but this is not assets we manage. This is Ether we secure. And this is what assets on chain kind of should start out looking like before they translate into user holding assets. Is that how are institutional holding assets or protocol holding assets getting secured by a layer that is dedicated to making sure that they can exist without Sybil attacks, they can exist without potential exploits on smart contracts, they can exist while being distributed across the globe and not being concentrated in one place, because our data centers can't get physical security. All we have is nodes on home computers. And I think the conversation of assets going on-chain and that kind of being end-all, be-all, to me feels a little incomplete, because you can't scale this sort of a financial institution or a financial market if you don't create the bedrock for that market. So for me, I'm a big champion of having the infra right first and then thinking about things. I think consumer crypto is still a long way away, but infrastructure for crypto can begin right now, and that's what we should be optimizing for solving.
Yeah, I mean, I was not really sure about how that worked underneath. So essentially what you're saying is we need a boatload of, like, say, crude oil secured in order for people to be able to trade it. And how would you say, like, poor bedrock? How would you explain a poor bedrock? What would it look like?
Yeah, no, that's a fantastic analogy. Actually, before the boatload of crude oil to be secured, you need to mine that crude oil also. make sure it's in a usable format so that it's filtered and so that all the impurities are extracted. You have to make sure that that crude reserve itself is also really stable, right? If it's like too vaporous, you'll probably combust if you use it. Think of it as when we talk about the old way of doing internet, assets here are like websites. You can't interact with a website if you don't have the TCP or the IP available for the website. And if that's not really secured by, in a traditional sense, an SSL certificate, you can't really do much with it. So websites are good and all, but what will you do if there's nothing to create a website on top of?
So basically like a DApp without a connect wallet option.
Yeah, potentially. Or maybe a wallet, like 100 users who have 100 hot wallets or MetaMask wallets with no DApp to connect it to.
That's
What are you doing with those wallets?
straight up stupid. Yeah, I mean, so far from all the conversations we have gathered that there is an influx of RWAs on chain, but to make it a success, we need a marketplace where people like solvers, companies are literally fighting to give you the right trade and also the right infra, the right backing for your assets to actually make sense online. The next sort of segment is pretty like it's open for everyone. Also, people in the audience for sure. I'm 22-year-old. I'm in Mumbai. My friend tells me this. There's this thing called Ethereum, or say Hype, for example, and he says that it's crazy. I want to buy it. He tells the guy that okay, go buy it. How would that look like? Why? Firstly, why should a guy buy it on chain? Secondly, what's the benefit of buying Hype in general?
Nice. Okay, so there are two ways. One is a traditional approach. You use a centralized exchange. You log on, you KYC, you wait for like maybe half a day to get verified. You have your account. You then deposit, from your bank via UPI or something. You now have your assets in custody with the centralized exchange. You don't own them, and you go on, and then you simply make the trade. Works quite simply. Let's say you want to buy any of these assets on chain. There are plenty of venues, but let's say you have an internet connection. You go, you figure out your, let's say you go to like trade.xyz. It's a market built on top of Hyperliquid. You log in via Google. They create a wallet for you in the back, and now you have to deposit funds into the wallet. The on-ramping problem exists. There are a lot of people working on it. So assume you are in a jurisdiction where the on-ramping problem is relatively solved. You've now onboarded into trade.xyz, and you're now just making a traditional swap. So the difference here would be, let's say, on an end money where you would want to buy an NVIDIA stock versus buying it on trade.xyz. The difference here is you get anytime like 24/7 access to markets, as Yash noted earlier. You get exposure to any assets over the world with just an internet connection, right? Like the Iran war is happening, you want to now express your opinion. How do you go and buy oil? It's hard. You go to trade.xyz with an internet connection, you can do it. So yeah, that's pretty much it.
So I would want to ask audience, how many centralized exchange users, people that have touched one sex? Okay, and how many people just like very on-chain first, like they've never touched a centralized exchange before? Okay. Yeah, I mean, I think I'm the sort of the best case for this. I started out with like centralized exchange, WazirX, stuff like that. Then like the core ethos of crypto was missing that. If I'm buying crude oil and like the price surges on WazirX, they just liquidate my position. Or like my crude oil is less valuable suddenly, even after the price spiked. That sort of brings me to my next question, right? We spoke a lot about infrastructure having the right bedrock, but then what about like for a normie user, they probably don't care about that. They are like the battle is not if to use onchain or not. You are literally competing in the app store as to what's trendy. How do we make it simple for users? Like from a Yash can talk about from a dev perspective, and others can talk about it from a user perspective. How do we make normies care about decentralization, about over collateralization and stuff like that?
Sure. So, first of all, I think a lot of the infrastructure is quite there to build products that are very, like you call it, normie friendly, abstracting away all of the gas, the transaction fees. Essentially, what they do is they just want you to come and trade as soon as possible without much friction. From a dev's perspective, there are a couple things you had to do before, but again, a lot of which where Tanay's company Propeller Shop has built like bunch of open source tooling for devs to tap into DeFi very easily. So that has also become a lot easier, but like we're still getting on the dev front of it. So using their products, anyone can build a solver, like he said, within a month. I'd challenge every dev to like build it in a week, especially now that you have Claude Code and other Codex coding agents. So yeah.
Yeah, that makes a lot of sense. I think from a trader point of view, they will only care about decentralization under usually one of two circumstances. One, you get lower spreads on chain than you would on NASDAQ. Number two, your assets can't be seized easily. Simple as that. So that is what self-custody brings you. Self-custody brings you the ability for you to own your assets, so no centralized exchange can, seize them on your behalf or the government's behalf. And I am a strong believer of, and this apparently is a contrarian position right now, but I am a strong believer of the fact that we can drive better trade outcomes for users if decentralization is done the right way. I'll pause over there.
But how do you get over? So from what I see, infra players just want to get something out there because like the users don't really care. They just want a representation of it online.
All of this is downstream of being able to provide lower spreads. So an example of how decentralization could provide lower spreads on chain. So if you're not familiar, there is a company called Flashbots, and they've been doing a lot of work on this primitive of programmable privacy. 2 years ago, they started off this discussion around trusted execution environments. And these are essentially black boxes where you can have software running in, and you can verify what is the software running, you can take measurements, and you can be sure, okay, I'm being told that this exchange works this way. So if it's running inside the trusted execution environment, my inputs will be private, and I can verify what is the code running on there. So decentralization is not just, it's a combination of like political decentralization, it's a combination of geographical decentralization, it's a combination of like technical decentralization. So all of those things together, so I was talking about trusted execution environments earlier, and what you could do is, in favor of decentralization, you could have, let's say, market makers co-locate in these trusted execution environments all over the world, and they could share sensitive information with each other without being worried that this useful information will be exploited. And this is not a primitive that is possible in TradFi. And this can enable better trade outcomes.
So essentially global coordination and like sort of permissionless global coordination where everyone in the equation is rooting for the trader.
Yeah, I mean, we have to, right? Like, what is the unfair advantage that crypto has? It is this permissionless decentralization, trustlessness kind of manifesto that we have. If we cannot use that to deliver better user outcomes, then we are going to lose to NASDAQ. Simple as that.
And as an extension to what Tanay just said, especially at the end, to bring back to your question, I also think that the end user or the retail user should not care. Like, infra should become so invisible and so in the background, and it should start becoming so robust that it shouldn't matter the technology that you're interacting with as long as the product or the value that you're getting out of it is at par or at break even with what a traditional product would look like. I don't know, just to take like a normie example, I guess, I mean, you could care less what stack Uber is on. And you're not getting GPay cashbacks anymore, but I think we are all using GPay all the time. Like it started out as, okay, you get an onboarding, some 150 rupee coupon or something like that. But I think we're all still using. And I think if GPay becomes chargeable tomorrow, chances are we'll not wean off immediately off of it also. I think what really matters is that the gap between infra and asset should start getting bridged, because I think infra is also investable now. And with a lot of solvers, etc., I think I'm excited to see how that also scales up to use cases like validation, and how can users start also benefiting out of overall decentralization for technology and networks.
That
To that point of like closing the gap between, which you rightly said, I'd encourage infra teams to like have really strong and tight feedback loops with whoever your target audience or end user is. So for example, when we were building Foundry, the benefit of building Foundry was that it had thousands of users and we'd get feedback every single hour basically. And we had really tight loops with our power user teams, such as Uniswap or Aave, to get really brutal feedback on how to improve the product despite being market leader. So yeah, I encourage all teams to like really tighten their feedback loops, find those early users, and yeah, just work on their feedback.
That's pretty cool. I think I've faced the consumer aspect of this where for Avantis, we spend like, this is my job, which is to spend most of my time talking to traders. Like I have seen people like make 100K and they're still giving us feedback as to how do you improve uh, our infra essentially. So far we've covered infra, why decentralization matters, why having the right bedrock matters. Now I want to make it a little more India specific. So like the problem statement here is that CFD trading in India is huge. It's also like a little gray. And then on-chain decentralization provides like a clearer solution. But then like, for me, there is probably a $1 billion market there. And if we are able to bring in like even 1% of it, we are winning. How do we sort of bridge that?
Could you tell me more about the CFD market? What is CFD?
CFD is basically futures and options.
Right, okay.
Yeah, like forex traders trading with leverage.
Yeah. Yeah, so I think to bring, let's say, the FNO market on chain, well, for one, there would be a lot of people arguing that perps are a better instrument
For sure.
to do that than futures or options. But if the question is more about why futures or options haven't taken off on chain yet, I think I think we're following a very traditional market maturation cycle. So usually, before you have lending markets, you need to have spot markets. So we start with good spot liquidity. Okay, the spot market is mature, now you can start building lending markets on top to kind of make the link as to why do you need spot markets for lending markets to work. Because let's say a user's over collateralized position is about to go underwater, you need to liquidate it, you need a venue to sell it into, right? Like if you sell the liquidated position into a market with not enough liquidity, then somebody won't be incentivized to liquidate that position, and you now have a bank that essentially can't pay its loans. So you start with deep spot liquidity, you now have lending markets. Okay, now you have lending markets, now you can start thinking about perpetuals on top. So now you have perpetuals on top. All of this is happening while liquidity is becoming deeper. You now have faster and faster oracles on chain. You have better understanding of risk, and now we are moving to a regime, especially it's apparent in lending now, where we will have fixed rate lending, where the time duration risk will start to be accounted for, and that's what's required for options and futures. And so I think it's more a matter of time and experimentation, where we now enter the phase where we have the maturity, we have the infra, we have the liquidity, we have the risk management to now start dealing with futures and options. And we already actually have one very compelling UX form factor of a options product. There is this product called Euphoria on Mega ETH. I'm not sure if you all have seen, but it's a very fun UX which is actually using options in the back. And I think it has the potential of being one of those breakout apps that makes options and futures actually start working more actively on chain.
mean, in my experience of talking to like these Web2 TradFi traders, it's like they're convinced that trading crypto is like trading on chain is the better alternative. But somewhere I have found that it's hard for them to trust smart contracts. They would rather trust their banks.
Yeah.
So how do like I think it's a mental barrier. How do we break through that?
I would like to take this to begin with. I think in terms of traditional banking and how we see traditional banks, it's true that a lot is dependent on trust. Maybe your dad knew a banker that you use now. Maybe your friend had a stockbroker who you trust and got them like really good returns, so you trust them to do your bags now. But I think even going back to the F&O question you'd asked, it's riddled with intermediaries to a point where it's really infuriating. You don't know where you stand in the process, right? Like tomorrow, if I have to go out there and buy a US stock, I'll have to go through such a hoop of regulations of KYC, of setting up my account, foreign remittance charges, I don't know, Forex, time zones, 100 things. Like thinking about it is exhausting me, and I haven't even thought about the full implication of it. You shouldn't trust a smart contract. I mean, you should have a healthy amount of skepticism and willingness to verify everything to do with money and not blindly believe anything and touch any of that without a 10-foot pole. But what you can do and where things change over here is that I'm not saying blockchain is inherently more trustworthy, but I'm just saying that it shifts where trust lies because it's verifiable. I can still go on chain and see where these billions of dollars in transactions are resting, where they moved, what channels they took, what made this tech possible, what's under the hood. Pull up Etherscan today, or pull up like whatever you like, PNB scan. And you still get to see the entire volume of where you stand. For DeFi also, when there is lending, borrowing markets, liquidity pools, from that to something as complex as a Pendle principle and yield trade-off strategy, I know where I stand at every point of time. I don't need to call up my broker and trust that he's also telling me the truth. Tanay spoke about the big shot, and no, he spoke about dumb money, but also talking about the big shot, or Bad Boy Billionaires has a new episode about Satyam. Why did we all get rug pulled? Because it's easy to change your books, and you can't change my verifiable ledger, which is on the internet.
But isn't that a little anti-UX? Like, if I'm notified of every single thing that's happening with my money, isn't that anti-UX for like a user in college who has like 10,000 rupees and he has just like bought ETH with all of it?
But can I also say something? I think the total addressable market that you are also talking about, and we just spoke about trade volumes and traders who also agree that on-chain is better. People who are mature enough and also trade by themselves without the need for any intermediaries are also a very small subsegment of the Indian financial market.
For sure.
Because all of us can't do it by ourselves unless we don't know the entry point. Internet money or blockchain or crypto can feel a little bit like the Wild West because you don't know where to start. Like I know CowSwap today because I work here or because like Tanay talks about it. But does anybody who's probably not in this vicinity find out about CowSwap just like that? Potentially not, right? The same goes for Sushi, Pancake, any DeFi, Balancer, Aave, whoever you want to talk about. And that kind of happens only because it's always difficult to navigate where you're an individual trader navigating this. In terms of bad UX and in terms of being notified about everything, once again, it's not about notification or information or being intimated through the process. It's not a push notification on your phone. It's your ability to be able to go and verify. And for me, that's why any kind of blockchain-based financial infra or the markets will keep winning.
I actually, there is an interesting product parallel here. So whether you trust a smart contract or a bank is also very nuanced. It depends on the place you are from and what is the economic privilege you come from. Most banks in India or the US that are FDIC insured, you're probably better off.
But then we are also trusting FDIC in this equation, right?
And that is a better trust guarantee than the security of a potential smart contract. But if you're in a country like, let's say, Argentina, and I think Yash with his co-founder Dharmi a few months ago did a pilot for this payments product in Argentina during DevConnect. And I think, I'd love to learn more about the trust requirements you learned about doing that pilot. And that was a, purely blockchain built app for payments.
Yeah. So in a country like Argentina, where the the people don't really trust the government or the central bank to be able to handle their currency stably, they tend to move towards these more decentralized, let's say, products like USDC, which is still centralized, but it's accessible to them via a decentralization layer called Ethereum. So what they rather do is trust that USDC smart contract, which is, by the way, verifiable, or USDT contract, or any other stablecoin contract, and trade in goods and services. And because the cash there so frequently devalues, they've also been very used to, let's say, technological like neo banks, let's say, digital banks, not only in crypto but like in TradFi as well, where they most of their financial activity would be happening just from their phone. So this was another, let's say, barrier that we didn't have to overcome in convincing the user that you need to be able to trust this technology that we're building. In markets like those, they're willing to trust. They're willing to take that leap of faith because their financial future is kind of at stake. Yeah.
I think this has been like a power packed session. My last question, and the audience can answer as well if they want. So we've spoken about probably as nuanced or as in in depth as possible about being like what it takes to be on chain and why it matters. So with all that as context, what do you guys think? How far away are we from like adoption or like that one breakthrough app that will sort of get all these college students in Mumbai downloading the app and trading on chain without knowing it? How far away are we?
Well, two parts to the question. One is just adoption in general. One might argue what that is, but we've seen massive success with stable coins already. In other ways, when does Nasdaq come on, Ethereum? I don't know, maybe 8 years. I don't know. But as far as when do people in this audience come on chain more easily, I think the bottleneck there is probably more on the regulation front than on the product front. Not an expert on that, so I'll leave it over there. So yeah, that's what I have to say on the topic.
Yeah, I think I want to say that maybe it is when, once again, the tech that can seem so alienating, like the moment you hear blockchain or crypto, it's like an alarm bell of something that's unfamiliar to me, and maybe that's why a lot of new people could remain skeptical, because it's not as proven as paper money or fiat is, right? Like you know where to go and get cash, just ask your mom, I mean. But you don't know how to be onboarded onto this. I think it is the moment the tech becomes invisible. The next time there is an app that nobody says is a blockchain or a crypto-based app, but the app or the product is so cool that people want to engage with it, the moment the stack on which it's built takes the backseat and goes in the background, I think we'll find a lot of people wanting to try it out and downloading hot wallet apps. And
So you're basically talking about polymarket.
potentially, because why not?
What about you?
I think largely in terms of what we need as like infra or any other market microstructure, we're already about there. In terms of adoption, like Tanay said, regulation, and I'd second that. But it also depends upon individual teams being able to deliver the right products, bridging the the infrastructure, which is like crude and let's say decentralized, bridging those properties and building that into a very smooth, beautiful UX product is a humongous task. So I applaud the teams who've already done that. But yeah, so it's very team dependent.
Perfect. I think that is it for the session. If you guys want to plug something, just go ahead. This is your time to shine before they kick us out of the stage.
Okay. So maybe not the plug, but if you all found anything interesting about what we spoke about today, some links I would recommend you all check out. Go to orderflow.art. That flow that I described earlier of like 35 entities competing for your trade, you can actually see that, visualize that on that link. Go to trade.xyz. It's an excellent product. You can buy oil and everything on there. and crypto. So I think the UX is there. Check it out. And yeah, go to propellerheads.xyz. Read up our blog. I think we have some interesting ideas on how decentralization can fuel better user outcomes.
Read everything Tanay said, and also go to ssv.network and read our blogs. The thing is that everything to do with new technology is always alienating. I remember how skeptical and apprehensive I used to be when I was writing my thesis back in 2017, and I was researching border security. And there were trades and tariffs and taxes for goods and services. There was nothing for ideas. There was no way to tokenize or monetize them, except IP and intellectual property, which was a long, wound out and drawn out process. But the blockchain could do it. And that's why I started, and you just need that one small thing to kind of put that thing in your head and take you down the rabbit hole. I just guess the only plug is read, become like a little bit of a nerd about it, and I'm sure you'll find something that resonates with you.
Yeah, so since we've been talking about RWAs and all of that, if you want to take a bet on like a real world event such as the US-Iran war or like sporting events or like the Oscars, which is coming this weekend, go straight ahead to copilot.markets, which is the most easiest and place to take a bet on these kind of events. It's agentic first. It's your companion to take any sort of bet on Polymarket. Yeah.
Nice. Thank you.
Thank you so much, guys.